According to a study published by the Brookings Institute in February of 2020, the typical white family in the United States of America had a net worth of $117,000 in 2016. The typical black family had a net worth of negative $17,000. Net worth is assets minus liabilities. I made some index cards with some financial definitions for my son. My objective is to prepare him for the real world. So periodically we talk about various terms and we talk about real world situations. An asset is something of value that you own. An example is real estate and stocks. Liabilities are financial obligations. An example is credit card debt. It's something you owe to someone. Debt is money you owe to someone. An entrepreneur is someone who starts a business. It takes risk to start a business. Risk is the possibility of a loss. A stock is a share of a company. It's part of a company. So if you own one stock at Amazon.com, one share of stock, you own a part of Amazon.com. And it's never been easier to buy stock. There are a lot of brokerages that actually allow one to buy fractional shares. So even if a stock is high priced, one can buy a fraction of a share today. Real estate is houses, buildings, and land. There's two types of real estate: residential, where people live, which is a house, apartment, or condominium, and commercial real estate, where businesses are located. One way to increase net worth is to invest, specifically to invest for the long term. I'm looking at a stock chart of Amazon.com on a website called TradingView. Each one of these bars represents a 1-month time frame. I like to look at charts as I analyze investments that I own and as I look at potential investment opportunities. There are many types of investments: stocks, bonds, mutual funds, real estate, and many types of investment companies. Many of these are mentioned in some books that I mention later on in this video. But one key in investing is starting early. The earlier one starts investing, the longer the investments have the opportunity to grow. So let's look at one of my favorite stocks, Apple. In April of 2013, Apple's price was $13.06. And recently, in October of 2020, Apple's price is $121.21. Investing doesn't have to be complicated or scary. One can buy individual stocks, and one can also buy mutual funds. A mutual fund is a professionally managed investment that groups a pool of money from investors to purchase securities. A very popular type of mutual fund is an index fund, and specifically the S&P 500 index fund is extremely popular. Several companies offer them, including Fidelity Investments, Charles Schwab, and Vanguard. The S&P 500 index is an index of 500 large stocks. So an S&P 500 index fund offers instant diversification, meaning if one of those 500 stocks goes down in value, but the other 499 are going up in value, the gains more than offset the losses. Also, the S&P 500 index is periodically rebalanced. So poorer performing companies are removed from the index and new, better performing companies are added to the index periodically when the S&P 500 is rebalanced. S&P 500 index funds have been a good investment choice for many over the years. However, past performance is not necessarily indicative of how the S&P 500 index will perform in the future. A portfolio is a range of investments held by a person or organization. One should be careful of the assets they include in their portfolio and manage risk. Many corporate employees and executives generate a significant amount of wealth by being awarded stock from the company they work for. Investing in real estate is a path to wealth for many, from buying a home that increases in value over time, to purchasing properties that are rented to other people, to purchasing commercial properties that are rented to businesses and selling properties for a profit.
Rule of 72. 72 divided by an interest rate equals the approximate number of years it takes money to double at that rate. Example, 72 divided by 4 equals 18. Thus, it will take approximately 18 years for $10,000 to turn into $20,000 at 4% interest.
Anyone with an iOS device, iPhone, iPad, or even it's also available on a Mac. There's an app called Stocks, which is really cool. You can see financial news. You can track various stocks. It's powered by Yahoo Finance, so if you use a PC or an Android device, you can get the Yahoo Finance app. It'll do pretty much the same thing. You can track stocks, read up on financial news. Young people should think about investing. How a company makes money. What company might actually be good to purchase some stock in and hold for the long term? What are all the kids wearing at school? What products do you see that people just have to have and just have to buy? So if a company can sustain their earnings, that is one criteria that causes more people to potentially buy a stock and help drive the price higher. There's some other applications that are actually pretty cool. Stockmaster, this is something that can be used to watch the market, analyze stocks. The free version will have advertising. Same thing with Stocks Tracker. There's also CNBC, which will give you some very good financial news. Bloomberg is also a very great source of financial news. I look at Bloomberg every single day. Also, something I've subscribed to for more than 30 years, the Wall Street Journal. Very great source of financial news. There's a lot of knowledge in books. Here's an excerpt from the book, The Wealth Choice, Success Secrets of Black Millionaires by Dennis Kimbrough. During an economics class at Atlanta University, an inquisitive student asked the scholar and educator W.E.B. Du Bois for the quickest and surest way to prosperity. What I am about to share, Dr. Du Bois replied, you would do well to write on your heart and place in your purse. Many a ruined man dates his downfall from the day he began buying what he did not need. If you are in debt, part of you belongs to your creditors. To whom you give your money, you give your power. There are some concepts in investing that I'm going to go over. The time value of money, risk-adjusted return, and opportunity cost. So for the time value of money, I'm talking about compound interest. That's interest growing on interest over time. So using the formula x times the quantity 1 plus I to the nth power, I can figure this out. X represents the principal, which is your initial investment. I is your interest rate in decimal form. And N equals your number of years. So if you invest $2,000 and earn a 5% return per year for 2 years, how much money will you have at the end of 2 years? Using the formula, 2,000 times 1.05 to the second power equals $2,205, which is what you will have at the end of 2 years. So a profit of $205. Now simplifying this, I'll use a different approach. Starting in year 1, I take $2,000 and multiply that times 5% for a $100 profit. Then I add that to my original amount, and that's what I have at the end of year 1, which is $2,100. So in year 2, I take the $2,100 and I multiply that times 5% to get $105, my return in year 2. So 2,100 plus 105 is $2,205 at the end of year 2 for a profit of $205. A risk-adjusted return is a calculation of the profit or potential profit from an investment that takes into account the degree of risk that must be accepted in order to achieve it. Investing involves risk. Opportunity costs represent the potential benefits an individual investor or business misses out on when choosing one alternative over another. This is a Rolex Yachtmaster. I got this watch in 2003. It's part of a package deal. My wife got a Cartier watch on the same day. The cost of this watch in 2003 was $6,300. That's a little below the retail price. But what would that money be worth if I, instead of buying a Rolex, if I invested that money for the long term? I'm going to show that momentarily. Now, yes, I could sell this Rolex and I can get at least what I paid for it, or at least according to what these are going for on eBay, anywhere between what I paid up to about $8,000 on eBay right now. And I have it insured for $14,000 approximately, which is the manufacturer's suggested retail price right now for this platinum bezel Yachtmaster. But you have to always think, when you make a purchase, what else could that money be used for? Now, so yeah, $6,300 is a large amount, but smaller increments easily add up to $6,300. I talked about opportunity cost. Now, how much money would I have today if instead of buying that Rolex, I took that $6,300 and invested it and held on to that investment and let it grow for 17 years? I'm going to use a calculator from calculator.net. I'm using the finance calculator. So let's see. 17 years is the number of periods. The principal amount, the cost of the Rolex was $6,300. And I'm going to use 9.8%. 9.8% is the average return of the S&P 500 index over the past 90 years. And I'm going to use a payment of 0, because in this particular case, I'm basing this off of having an initial lump sum investment of $6,300 and letting that grow for 17 years and not adding to it as time goes by. So let's see what we would have after 17 years. After 17 years, the $6,300 at 9.8% would have grown to $30,873. The amount earned was $24,573. Wow. With any investment, one has to consider the impact of taxes. Since this is a long-term investment, long-term investments are subject to a lower tax rate than short-term investments. So I'm going to actually use the capital gains tax rate to figure out how much I would have after taxes. The current maximum capital gains rate is 20%. So for my gain of $24,573, if I multiply that by 0.8, that is my after-tax gain. 0.8 representing the 80% I have left after paying taxes. So my after-tax gain plus my original principal amount equals my cash available. So currently, I have $25,958 of cash available based on investing over 17 years and letting that money grow and accounting for taxes. This is enough to buy a brand new Rolex and have money left over. This is enough to buy several pre-owned Rolexes and still have money left over. A pathway to creating generational wealth is investing. Generational wealth represents assets passed down from one generation to the next. Decisions to spend money versus investing for the long term can magnify significantly over time. Suppose me and my wife gave this money to our son Bradley by putting it in a trust account and allowing it to grow over time. Using the same calculator over a 26-year period at the same rate of interest, Bradley will be nearly 40 in 26 years. At that point in time, based on these numbers, Bradley would have $295,074. The total gain would be $269,116. After accounting for capital gains taxes, Bradley would have $241,251 of cash on hand in the year 2046 from this investment. That's the earnings plus the original principal amount. However, the value of money erodes over time because of inflation. So I've used a calculator from Smart Asset to calculate the impact of inflation over time. I want to see what the purchasing power is in today's dollars. So the $241,251 using an inflation rate of 3% on average per year would have the same purchasing power as $111,867 has today. When analyzing investments, one should consider the impact of inflation. This is a good book for kids anywhere from 8 to 10 years old, but older kids would enjoy the book too. This is a good book for kids anywhere from 10 to 14 years old. This is a great book for parents, and this book, Make Your Kid a Money Genius, even if you're not, will help parents explain various financial situations to children of all ages, up to recent college graduates. There are essentially four things you can do with money. You can spend it, you can save it, you can invest it, or you can give it away. Use your money wisely.